35 years. That is the number every single pensioner in this country has heard at some point. 35 years of national insurance contributions and you get the full state pension. Simple, right? It is not. And the gap between what people think that number means and what it actually means is quietly costing couples in this country an average of £3,000 a year. Not once. Every year for the rest of their retirement. Here's the part that should genuinely worry you. You can work 35 years, pay every single national insurance contribution on time, never miss a payment, never make a mistake, and still receive less than the full pension. Most people watching this right now do not know that is even possible. I am about to show you exactly why it happens, who it happens to, and the one number you need to check today, because once that number is wrong, it is far harder to fix than you would think. I am John Hartley. This is Money in Retirement. Stay with me for the next 18 minutes because by the end of this video, you will know exactly where you stand, and more importantly, whether you are one of the people quietly losing money without ever being told. Before we go further, here is exactly what we are covering. First, I am going to clear up the single biggest misunderstanding about the 35-year rule, the one that catches almost everyone out. Second, I will walk you through the three groups of people this actually affects, with real numbers for each one. Third, I will show you the one document that tells you the truth about your own pension and exactly what to look for on it. And finally, I will give you the precise steps to take this week if something does not add up. Let's start with the misunderstanding, because almost nothing else in this video makes sense until this is sorted out. Most people believe the 35-year rule means this: work and pay national insurance for 35 years and you automatically get the full new state pension. That belief is wrong for a very large number of people in this country, and the reason is something most pensioners have never been told. The 35-year figure only applies cleanly to people whose entire working life sat under the new state pension system, which began in April 2016. If any part of your working life happened before that date, and for almost everyone currently retired or close to retiring it did, your pension is calculated using something called a starting amount. That starting amount compares what you would have received under the old rules against what you would receive under the new rules and pays you whichever is higher at the point the system changed over. Here is why that matters. If you spent years working for an employer with a defined benefit pension scheme, the kind that was common in the 70s, 80s, and 90s, you were very likely contracted out of part of the state pension during those years. You paid a lower rate of national insurance in exchange for building up that workplace pension instead. That sounds like a fair trade, and in many cases it was. But it also means a deduction called the contracted out pension equivalent was built into your starting amount. And that deduction can mean that even with 35 qualifying years on your national insurance record, you do not receive the full new state pension. You receive less, sometimes considerably less. This single fact, the existence of that deduction, is the reason couples across this country are losing an average of £3,000 a year between them. Not because they did anything wrong, because nobody ever explained that 35 years was never the whole story for people who worked through that transition. So let's break this down into the three groups this actually affects, starting with the one that catches out the most people. Group 1 is anyone who was contracted out of the state pension at any point through a workplace pension scheme and reached state pension age after April 2016. If that describes you, your starting amount almost certainly includes a deduction. Here is what that looks like in real numbers. Say you worked for a local authority, or a large manufacturing firm, or in the civil service, anywhere between the late 1970s and the early 2000s, and you were part of that employer's pension scheme. During those years, you were very likely contracted out. The amount of the deduction depends on how many years you spent contracted out, and your earnings during that time, but for a great many people it comes to somewhere between £8 and £20 a week. That might sound small on its own. Multiplied across a year, that is between £400 and just over £1,000. Multiplied across two people in a household who were both contracted out at different points in their careers, that is where the £3,000 figure for couples comes from. The reason this group rarely finds out is straightforward. Nobody from the Department for Work and Pensions sits you down and explains the deduction in plain terms. It is buried inside your state pension forecast as a single line, often without any real explanation of what it means or why it is there. Group 2 is people with gaps in their national insurance record, usually from time spent caring for children, caring for a relative, or time spent unemployed without claiming the credits they were entitled to. This group thinks they are short of the 35 years, full stop, and assumes there is nothing to be done about it. In a large number of cases, that assumption is wrong. If you were claiming child benefit for a child under 12 at any point since 1978, you were very likely entitled to something called Home Responsibilities Protection, or its modern equivalent, National Insurance Credits for Parents and Carers. These credits fill the gap in your record for those years, exactly as if you had been working and paying national insurance directly. The difficulty is that an enormous number of people, particularly women who took time out of work in the 1980s and 1990s to raise children, were never properly credited. Revenue and Customs has acknowledged this publicly, and a correction process has been running for several years now, but it relies on you applying. Nobody automatically checks your record and adds the missing years for you. If you fall into this group, the gap in your record might not be a real gap at all. It might be a credit you were always owed that was simply never applied. Group 3 is the smallest group, but often the most painful one to discover late. People who paid voluntary national insurance contributions to fill a gap, without first checking whether those years would actually increase their pension. Here is how this happens. Someone notices a gap on their record, perhaps from a year spent working abroad, or a year of low earnings, and pays to fill it voluntarily, sometimes at a cost of £800 to £1,000 for a single year. That feels responsible. In some cases, it is exactly the right move. But because of the starting amount calculation we talked about earlier, some people had already reached the maximum pension they were ever going to get under the rules that applied to them, regardless of additional years. For those people, paying to fill an old gap added nothing at all to their eventual pension. The money was spent for no increase whatsoever. This is not a common outcome, but when it happens because nobody checked the actual effect of filling that year before the payment was made. And once that voluntary payment is made and accepted, getting it refunded is extremely difficult. So how do you find out which of these applies to you, or whether none of them do and your pension is exactly what it should be? There is one document that answers this honestly, and it is free. It is called your state pension forecast, and you can request it from the government's own pension service. It will show you 3 figures that matter far more than the headline 35-year number. The first is your number of qualifying years to date. The second is your forecast amount based on those years. And the third, often the one people skip past without reading properly, is a line that tells you whether your forecast already reflects deductions from being contracted out. If that third line shows a reduction, that is your confirmation that the starting amount calculation has applied to you, and it is worth understanding exactly how much that reduction is costing you each year. The forecast also tells you, very specifically, how many more qualifying years would increase your pension, and by how much, if any years, would increase it at all. This is the single most important piece of information in the entire document because it tells you, before you spend a single pound on voluntary contributions, whether doing so will actually help. Here is exactly what I would do in your position, broken into 3 simple steps. Step 1. Request your state pension forecast if you have not looked at it in the last 12 months. Rules and your own record can change, and an old forecast may no longer reflect your current position. Step 2. Look specifically for any mention of a contracted-out deduction or a difference between your old rules amount and new rules amount. If you see one and you do not understand why it is there, call the Future Pension Center and ask them directly to explain the figure in plain terms. You are entitled to ask, and they are required to explain it to you. Step 3. If you are considering paying voluntary contributions to fill a gap, do not pay a single pound until the forecast or the Future Pension Center has confirmed in writing that the specific year you are filling will actually increase your pension. If it will not, that money is far better spent or saved elsewhere. If you went through this checklist with your partner as well, and most couples never have, you may well uncover that £3,000 figure sitting quietly in your own household, split between 2 contracted-out deductions nobody ever explained properly. If this has been useful, there is another video on this channel that goes through exactly how to read every single line of your state pension forecast, including 2 figures buried near the bottom that almost nobody checks and what they mean for the amount you will actually receive. The link is in the description below, and watching that one alongside this one will give you the complete picture of where your pension stands and whether there is genuinely anything left to claim. If you know someone who worked for a company pension scheme anytime in the 70s, 80s, or 90s, particularly someone who has never once heard the phrase contracted out, please send them this video today. This is exactly the kind of gap that sits quietly for decades and is only found by accident, if it is found at all. Subscribe to the channel if you want plain English explanations of exactly what is happening with your pension, your tax, and your benefits, with nothing assumed and nothing left out. Turn on the notification bell so you do not miss the next one. I am John Hartley, and I will see you in the next video.